Not long ago, back in the ancient times of 2024, the experts told us that 5% interest rates would crush the economy. You might remember when the Fed promised a soft landing, which turned out to be code for we are going to monetize the debt so hard that your savings account becomes a historical artifact. And yet, somehow, Wall Street has started 2026 by pulling off the biggest rug pull in history. Unlike the recession we were promised, the S&P 500 just pumped to an all-time high, strictly because tech companies figured out they could fire their entire junior analyst cohort and replace them with a single CUDA kernel. In today's video, we'll find out if the yield curve is still inverted or if Jerome Powell just decided to ignore the laws of mathematics. It is January 16th, 2026, and you're watching The Margin Call. Back in my day, value investors would get their wiggles out by reading 10Ks and looking for PE ratios under 20. But nowadays, all the cool kids are leveraging 100x on prediction markets to bet on whether the US Treasury will mint a trillion-dollar coin before or after lunch. Like, imagine you needed to know which asset class was the best hedge against the debasement of currency. Regardless of which one you choose, odds are big tech AI is at the top of the list. We are seeing a market bifurcation where 7 companies comprise 40% of the entire index, effectively turning the US retirement system into a levered bet on GPU shortages and data center energy consumption. Now I know, trust me bro, technical analysis isn't everything, but it's been a minute since we've seen a market detached this far from fundamental reality. And if you don't really trust the charts, look at the labor market. Major banks just announced another round of layoffs, citing efficiency gains from their internal LLMs, which is corporate speak for the robot does Excel better than you do. That's impressive, but the currency war is still raging. The US national debt just passed a psychological milestone that makes the GDP look like a rounding error. The interest payments on the debt are now the single largest line item in the budget, surpassing defense and Medicare. This mathematically guarantees that the money printer must go burr indefinitely to pay the interest on the money that was already printed. It is the Ouroboros of fiscal policy. This brings us to the housing market, which, unlike the stock market, is completely broken for actual humans. Institutional buying of single-family homes has accelerated, with private equity firms converting entire neighborhoods into subscription living services, which accelerates your entire homelessness life cycle with monthly recurring revenue, which is kind of like feudalism, but with a better app. And finally, we have to talk about the digital dollar pilot programs rolling out this quarter. While they promise convenience, privacy advocates are noting that these central bank digital currencies, CBDCs, look suspiciously like a surveillance database masked as a bank account. Their biggest competitor is obviously Bitcoin, which remains the only asset that the CEO of the Earth can't dilute on a whim, recently reclaiming its dominance as the checkmate to fiscal irresponsibility. This has been The Margin Call. Thanks for watching, and I will see you in the next bankruptcy hearing.